All of this is a good place for them to sell the longs that they started accumulating down here. Look how much time they whip back and forth in that range. All these wicks, okay? They're selling all the positions they've accumulated here, and down here on the initial rundown into the support. Once this range is closed in, the next area of concern is just above this short-term high. So our void filled in right here. It's filled in. So this is no longer an area of interest, no more. Now we still look for higher prices. Why would we still look for higher prices? Because they went long here, okay? So if they're going to look to sell their position, where would they look to sell their positions at? Discount prices or premium? Premium. But the premium price that speculators would trade at by buying and chasing price, it's a premium to price chasers, people that feed off the desire of being in a price move that's already been moving higher. It's fair value to the market maker to liquidate their positions at this small little pocket between this up candle's low and this up candle's high. So we can now create a new specific area of fair value for the market maker to liquidate their long positions in here, right in here. So drawing that out in time, that's what you see here. Price coming right into the bottom of that candle, hits it perfectly to the pip. Bodies of the candle are still deep inside the shaded area for fair valuation. What makes it fair is because they bought it at a deep discount and they're liquidating at a premium. It's fair for them to accumulate here, and it's fair for them to liquidate. See, market makers have to deal in terms of valuation for their longs and their shorts, and they have to do that same valuation for their exits on both sides of the marketplace. So when we see inefficiency in price, like we see here with these candles, just only going down, no up movement in it, only going down here, no up movement in it until later on, all of this area, they're scaling out their positions that they accumulated down here, here, and here. When price moves in defined trading ranges, there's going to be equilibrium. Equilibrium is in itself fair value. That means the market makers are holding it in a consolidation. When that consolidation gives way, the strongest move out of that consolidation on a hard time frame chart will give you a great deal of prognostication for directional bias. So what I mean by that is if we look at price, and we take a look at it like this, we can look at price like from this high down to this low. So we have a range defined there, okay? The market's in this range here, consolidates, it goes right back to equilibrium, hangs around equilibrium, dips down below equilibrium. So even if we're monitoring this range from this high to this low, we're below the equilibrium price point. So are we at a premium right here, or are we at a discount? We're at a discount. Traders on a retail level, they're going to see this as a selling point. They're going to want to get short because they're going to see this high to this low coming up to 62% retracement level. Remember, I said in the last two sessions, it's not enough to simply looking at Fibonacci. You can get tripped up in Fibonacci if you don't understand what price is actually telling you. So getting